Petrol prices in India are rising again. Diesel prices are jumping. The rupee is falling. And most people still think this only affects how much they pay at the petrol pump. But what if I told you? Rising oil prices can quietly destroy your savings, reduce your SIP returns, increase your EMIs, and even crash parts of your portfolio? And at the same time, some sectors can make massive profits from this crisis. In the next few minutes, I'll explain why oil prices are suddenly exploding again, how this affects inflation, stocks, mutual funds, and your daily life, which sectors will suffer, which sectors could benefit, and what smart investors should do right now. Watch till the end, because I'll also share my short-term prediction for oil prices and what could happen next in India. India imports more than 85% of its crude oil needs from other countries. That means, whenever global crude oil prices rise, India feels the pain almost immediately. And right now, global oil markets are under serious pressure because of Middle East tensions, supply disruptions, and fears around the Strait of Hormuz. Brent crude recently crossed $100 per barrel again, with prices touching around $106 to $113 in recent weeks. And because of this, India has already seen multiple petrol and diesel price hikes this month. This is not just a fuel problem anymore. This is becoming an economy problem. Let's first understand why oil prices are rising so aggressively. There are three major reasons. Number one, geopolitical tensions. The Middle East controls a huge portion of global oil supply. And right now, conflicts involving Iran and disruptions near the Strait of Hormuz are creating panic in global energy markets. Nearly 20% of the world's oil passes through the Strait of Hormuz. So even the fear of disruption is enough to push prices higher. Number two, supply concerns. Oil producers and refiners are struggling with supply chain uncertainty. Indian companies are now reviewing oil imports daily and increasing spot purchases because long-term supply chains are getting affected. Number three, weakening rupee. Oil is traded globally in US dollars. So when the rupee weakens, India effectively pays even more for crude oil imports. Recently, the rupee touched record lows near 96.5 against the dollar. That creates a double problem: higher oil prices and a weaker currency. Most people think oil prices only affect petrol and diesel. Wrong. Oil affects almost everything in your life because transportation runs on fuel. When diesel prices rise, truck transport becomes expensive, food becomes expensive, online deliveries become expensive, flight tickets rise, cab prices rise, and even vegetables and milk become costlier. This is called cost-push inflation. And India is extremely sensitive to fuel inflation because energy impacts farming, transportation, manufacturing, and logistics. So even if you don't own a car, you still end up paying for higher oil prices indirectly. Your monthly expenses increase quietly. And here's the dangerous part. Your salary usually doesn't rise as fast as inflation, which means your real purchasing power falls. You earn the same amount, but can afford less. That's how inflation silently makes people poorer. Now let's talk about your investments, because oil prices have a massive impact on the Indian stock market. When crude oil prices rise sharply, foreign investors become nervous, inflation expectations increase, the rupee weakens, and companies face higher operating costs. This creates pressure on the Sensex and Nifty. During recent oil spikes, Indian investors lost huge amounts of market value as markets corrected sharply. Now let's break down sector-wise impact. First, airlines. Aviation fuel is one of the biggest expenses for airlines. So when oil rises, airline profits fall. Second, paint companies. Many paint products use crude oil derivatives, so raw material costs increase. Third, logistics and transport companies. Higher diesel means lower margins. Fourth, chemical companies and manufacturing businesses. Production costs rise significantly. Fifth, FMCG companies. Transportation becomes expensive, packaging costs rise, and profit margins get squeezed. So if oil prices remain high for a long time, many sectors start reporting weaker earnings. And that hurts stock prices. But not every company loses money. Some sectors actually benefit. First, upstream oil companies. Companies involved in oil exploration and production can earn more when crude prices rise. Second, energy exporters globally. Third, certain government-linked oil businesses may temporarily benefit from inventory gains. Analysts recently said higher Brent crude prices could improve earnings for upstream energy firms while hurting oil marketing companies. This is why smart investors always understand macroeconomics, because sometimes the same event destroys one sector while creating huge opportunities in another. Now comes the part most people ignore. Oil prices can affect your EMIs. Here's how. When inflation rises because of fuel costs, the RBI may avoid cutting interest rates aggressively, and in extreme situations, rates can even rise again. That means home loan EMIs stay high, personal loans remain expensive, credit becomes costlier, and businesses slow down. And when borrowing slows, economic growth slows too. This is why central banks across the world watch oil prices very carefully, because oil inflation spreads into the entire economy. Now imagine this scenario. What if crude oil rises to $120 per barrel? India could face higher fuel prices, higher inflation, a weaker rupee, slower GDP growth, lower corporate profits, and pressure on stock markets. Government finances may also come under pressure because India sometimes reduces taxes or absorbs some fuel shock to protect consumers. But that creates another problem: fiscal stress. This is why oil is one of the most powerful economic variables in the world. It affects governments, markets, inflation, and even elections. So what happens next? Here's the short-term outlook. Right now, markets are extremely volatile. Some analysts believe oil could remain above $100 if geopolitical tensions continue. Others believe prices may cool later if supply normalizes and tensions reduce. But in the short term, the risk is clearly on the upside, especially if Middle East tensions worsen, the Strait of Hormuz faces disruption, or the rupee weakens further. That could lead to more petrol and diesel hikes in India. And we are already seeing early signs of that, with recent price increases across cities. Now the important question: what should you do as an investor? First, don't panic. Oil spikes create volatility, but volatility also creates opportunities. Second, avoid overexposure to sectors heavily dependent on fuel costs in the short term. Third, continue SIPs if you are a long-term investor. Market corrections are temporary. Long-term wealth creation still depends on discipline. Fourth, keep some cash ready because if markets fall sharply due to oil panic, quality stocks may become available at attractive valuations. Fifth, diversify globally if possible, because global macroeconomic shocks affect all markets differently. And finally, focus on companies with strong pricing power. Businesses that can pass rising costs to consumers usually survive inflationary environments better. This is why financial education matters. Because most people only react after prices rise. They complain about petrol, but never understand the chain reaction happening inside the economy. Oil prices affect your grocery bill, your SIP returns, your EMI, your job market, your travel expenses, and even your future savings. And the people who understand these cycles early usually protect and grow their wealth much faster. So here's the big takeaway. Oil prices are not just an energy story anymore. They are an inflation story, a stock market story, a rupee story, and a personal finance story. The next few months could remain highly volatile for India because of global crude oil uncertainty. So stay informed, stay diversified, and most importantly, don't make emotional investing decisions during macroeconomic panic. If you found this video valuable, hit the like button and subscribe because I break down finance, economics, investing, and global events in the simplest way possible. And comment below, do you think crude oil will cross $120 this year? I read every comment. See you in the next video.